Hello there, Hector Davil here. In this particular video, I want to teach you one technique that's especially helpful for intraday traders. Now, if you are not an intraday trader, don't run away, stick around with me, give me a few minutes, I'm gonna teach you something really cool, okay? But if you are indeed an intraday trader, well, sit back in your chair, pour yourself an orange juice or a beverage because you are going to learn something that's going to blow your mind, okay? Make sure to stick around through the video. So what we're going to be talking about today is the average daily range, which is, believe it or not, the best tool as far as locating your profit-taking levels. Now, you know that whenever you are to take a trade, you need to take into consideration your entry level, your stop loss level, and your profit target level. And funnily enough, sometimes it's easier to determine at what point you want to enter into the market than at what point you want to exit the market, right? Entering the trade is something that we all have in mind. We all have a set rules as far as taking our trades. However, it's not so clear when it comes to actually close out the trade, right? We don't really know exactly what's the optimal area, the optimal level in our chart where we want to cash out our profits and call it a day. Well, that's exactly what we are going to focus on today. All right, again, I'm going to teach you one fantastic technique that's going to help you in this regard. All right, let's get going. Okay, so the question remains, how can we possibly use the average daily range in order to locate our ideal targets as an intraday trader? Well, first of all, before I get down to the specifics, we need to define the statistical average. What is the average daily range? Well, it's the average number of pips any particular currency pair moves every day, okay, on a 24-hour period of time. Please mind that not every currency pair has the same average daily range. All right, there are obviously some currency pairs that are more volatile than others, and therefore they will have a larger average daily range. Anyway, so why should we keep in mind, why should we be aware of the statistical average for every currency pair? Well, here is why. I'm going to give you an example and you're going to understand it right away. Alright, let's imagine this is our chart for the euro against the American dollar, for example, okay? It can be any currency pair. And this is price action. This is obviously the beginning of the day. You've been following price action all day long, searching for a trade, and at that precise moment, right there, your system signals a buy entry. Right there is where you click on your buy button. Now, obviously, you need to determine at which level you want to exit that trade, right? At what level you want to cash out your profits if you are, hopefully, to score some profits. Now, let's imagine you've calculated the average daily range for the euro against the American dollar and you get an average of 120 pips per day. That means that the distance between the low and the high for the day on this particular currency pair is 120 pips on average. All right? So what you want to do now is to take the low for the day and project 120 pips to the upside. And that would take us all the way up there. And now we know at what level we may find some exhaustion from a statistical point of view on this currency pair. Do you see where I am getting down to here? If this is the exhaustion point, and therefore that's the farthest price may run from a statistical point of view, do you really want to locate your profit-taking level anywhere beyond that level? Anywhere beyond that limit point, so to speak? Well, no, you don't. Because if you do, you would be stretching your chances beyond what's statistically possible, beyond what's statistically feasible. All right? So, in order to make sure that we have the statistics on our side and not against us, you always want to locate your target within the average daily range. All right, always place your intraday targets within the average daily range from the low of the day projecting the average daily range to the upside, or if we were searching for a short opportunity, if this was a sell opportunity, we would take the high for the day and then we would project those 120 pips to the downside. All right, as simple as that. So that's how the average daily range can help us trading within what's statistically possible. But actually it has a second benefit, and that's to help us capturing the main move for the day. And again, we are going to use exactly the same line of thought here, the same train of thought. If we know that from a statistical point of view, the euro against the American dollar moves 120 pips, as we've already established, we don't want to shoot for 130 or 140 or 150, etc., etc. We don't want to do that. But at the same time, we don't want to give up on potential profits, right? So if the euro against the American dollar moves 120 pips, why should we settle for 60? It makes no sense. I mean, we know that, again, from a statistical point of view, we can possibly squeeze 120 pips on average on this currency pair every single day, right? So why should we settle for less? Why should we settle for 60, 65, 70 pips? It makes no sense. You are leaving a number of pips on the table every single day. So the idea here is to push your final target as close as possible to the average daily range projection, obviously, as long as you don't quite push it anywhere beyond that level, right? So my personal recommendation, what I do myself in my own trading, is to shoot for somewhere in between 80 and 80% of the average daily range. So if the range is 100, the statistical average is 120 pips, what I usually do is to shoot for 100 pips, okay? Simply take the low for the day, project 100 pip, and to the upside, and that's where you want to exit that's where you want to locate your final target. And by doing so, you will be fulfilling the two requirements the two characteristics we require from the average daily range. First of all, we are going to be capturing the main move for the day. I mean, well, 100 pips out of a total of 120 is not too bad at all, is it? Not too bad at all. You don't want to be overly aggressive with your targets, but also you're going to make sure that you are trading within what's statistically possible by not placing your target anywhere, beyond the exhaustion level. So, like I say, 85% of the average daily range is a sensible decision, and around that area, around that ballpark, is where you want to close out your intraday trades. Alright, now, since I know that calculating the average daily range and the average daily range projections can be a pain, fear not, don't you worry, I am going to share with you my customly coded average daily range projection, which again has been custom coded by my personal programmer. Well, please take a look at my screen. We are looking into the sterling pound against the Japanese yen on the 1 hour time frame, and down here we can see a little bit of some information, some bits of information. Today this particular currency pair has moved 129 pips, right? That means that the high for today, the distance between the high and the low for today has been 129 pips. Now the statistical average is 200 pips. I think the indicator keeps track of the last 14 days. That means that it calculates the average as per the last 14 days worth of price action, and again the average is 200 pips on a daily basis. Now, the average daily range projection to the upside is 137.22. That means that if you take the low for today and add 200 pips to the upside, that takes us all the way to 137.22. And the average daily range projection to the downside is 134.51. So you take the high for the day and add 200 pips to the downside, and it takes you all the way to 134.51. You will also see two sets of lines on the actual chart, right? The thick lines, the black lines, are the average daily range projections in themselves, okay? This is obviously the average daily range projection to the upside, and this is the average daily range projection to the downside. And this thinner line here, the gray line, is the 80% of the average daily range projection of these levels down here. Okay, so the distance between here to here is 80% the distance between here and here. Okay, so assuming your intraday trading system gives you a sell opportunity at that precise moment, you would be looking to place your final profit taking level somewhere in this area there. Probably closer to the 100% average daily range projection if you are an aggressive trader, or probably closer to the 80% of the average daily range projection if you are a conservative trader, which is my recommendation. My recommendation is always to be conservative with your targets. In the other hand, if your system signals a buy entry, well, this is the area you would be shooting for. Okay, again, depending on whether you are conservative or aggressive. Anyway, that's all I have as far as the average daily range and the average daily range projections go. Obviously, you are very welcome to download my custom indicator. You can find the download link under this video, and also you will find the link to the MetaTrader broker that I personally use. Okay, the one I personally recommend, in my experience, is just proven to be the most reliable of all. But again, that's just my personal experience. And as usual, please drop your comments, leave your feedback under this video. You will find the comments section. Let me know whether you enjoyed this video, whether you enjoy this presentation, whether you enjoy the indicator, etc, etc. Anything you may want to say, feel free to speak up your mind, okay? Alright folks, thanks for watching. Cheers!